month, so we hope you will join us in celebrating it too. As you will see in the chat in a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. A couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. We'd love to see where you're from. Secondly, we're going to open up for live Q&A near the end of each session, so please submit those questions for us in the Q&A function at the bottom of your screen throughout the presentation. We'll try our best to get to them all. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft's Entrepreneurship for Positive Impact, BPM, and HubSpot for startups. We're humbled and grateful for their contributions. Before we get started, I'm going to start by launching a couple polls to take a step back and take a temperature gauge on how everyone's doing today. Plus, look to learn a little bit more about where you're learning from. Looks like we've got London, Kansas, Maryland, Winnipeg. All right, all over. I'm going to start by launching this first poll to let us just know how you're feeling about your business right now. We've been measuring this since the beginning of 2020. We do know the entrepreneurial journey is a lonely one, and also we at the center provide a ton of wellness resources for entrepreneurs. So thanks for letting us know how you're doing. Hopefully optimism is on the rise. We do know the end of year is nearing. All righty, I'm going to end this poll. Share those results. Looks like optimism is in the lead, but totally understand there's a little bit of survival mode, anxiety, and fear out there. Hopefully our sessions today and the ones in the future will help alleviate some of those. In our second poll, we're gonna look to learn a little bit more about what side of the M&A process you're looking to learn. So I'm gonna launch this real quick. Which side? Are you an entrepreneur looking to learn more about selling? Are you in corp dev looking to learn a little bit more about the buy side? Let us know. It'll help us and our moderators this afternoon and morning understand where we're looking. All right. Oh, almost a quick 50-50 split. I'm going to end this, share those results. Oh, a little bit more on the buy side, but still a pretty good even match. So thanks for sharing that with us. We will get to both sides of the process. So before we jump into the content for this morning, we're going to kick off with a quick agenda overview. So first, we're going to kick off the program with a market update with our good friend JP, and then our M&A strategy for early to mid-stage entrepreneurs panel. Then we'll have a quick 10-minute break, then transition into panel 2, where our panelists will share growth through acquisition, the buy side overview. So for those of you who are looking for the buy side, that's your place to be. Please note that the same Zoom link will be used for both sessions. So without any further delay, please join me in giving a warm welcome in the chat to our first presenter to share the M&A market update. JP Diddy is the Managing Director at KPMG. JP, welcome.
I appreciate that, Colin. Good morning, everybody from the West Coast of the United States. Appreciate the invite to be here and give a little update on the current markets. I'm going to share my screen here, so hopefully that will work okay. Are we good, Colin?
Looks great.
Okay, appreciate it. Quick market update. Scroll through a couple slides here. First slide, I'd be remiss if I didn't mention KPMG Corporate Finance. We're the largest boutique you've probably never heard of. You've definitely heard of KPMG as an accounting and tax firm, but a third of our business is what we call advisory services. I lead the software practice out of the West Coast, and we do more deals every year than any other firm on the planet in helping entrepreneurs realize the success of their business. So that's the quick commercial, if you will. The market outlook. First page here, I apologize, I'm scrolling for some reason, it's not clicking down. 6 quick bullets here from last week that have carried over this week and have really been the theme over the last several months within the markets. Number 1 right there is Jamie Dimon mentioning that we are absolutely looking to head into a recession, and most of the pundits probably agree with that, but no one quite knows the timing. The second one down is the Nasdaq is at our lowest point over the last 2 years. So the last couple of years of that bull market up and to the right have been wiped out. So that's obviously a bit disappointing, which will carry into valuations, which we'll see in a second. Third one down is the interest rate for mortgages reached over 7%, which compared to what a lot of us have done on the refinancing side over the last several years seems absolutely crazy. That also is interest rates for businesses as they borrow to fund their growth. Upper right is the weakest global economic outlook in 20 plus years. Not good news as well. The World Bank below that talking about the Russian war and the humanitarian crisis that is causing, both from a fuel perspective as well as a food perspective. Obviously, that's a issue that is affecting that region, but really bleeding over to the rest of the world, which is something I know we all hope gets resolved as quickly as possible. And then finally, the dysfunction in the UK markets down on the right, which is UK, one of the largest economies in the world, and on the brink of some financial instability there. So that's all really bad news, and that's what we're dealing with from a market perspective currently. As we look down to the next page, our market performance over the last at least year to date, everything is down. It's been a dropping rock, if you will, down 18, 20, 25% across the board for the S&P, NASDAQ, and Dow and Russell. Obviously, this is a little bit of a myopic view since it is just a U.S. market focus, which I apologize for, but the global markets have pretty much had the same downturn over the last 10 months or so. How has this affected I guess it hasn't affected it, but it all ties together. As you see from this slide here, the private equity and venture capital deal activity has started to wane. It's still historically pretty consistent with the 2019 timeframe, but for venture capital, we peaked in for private equity, we peaked in Q4 of 2021. And for venture capital, we peaked in Q1 of 2022. So really the last 3 and 4 quarters for each of those metrics have been declining from a deal activity perspective. But keep in mind that is still coming from an all-time high. So a little bit of downturn from there is, obviously not the end of the financing world, but certainly a trend that seems to be continuing to go downward. I'll turn a little bit more to technology specifically, since that's where I spend most of my time. As I mentioned, I lead the software practice, so software is near and dear to my heart within the markets. But tech acquisitions, similar to the slide we just saw from an overall market perspective, are also leveling off. You'll see in all 4 of these charts, from the tech M&A activity on the upper left, mega deals bottom left, private equity on the upper right, and strategic acquisitions on the bottom right. Those are all declining since the peak of Q1 2022. So again, most things within the market are in a downward trajectory, but again, coming from all-time highs. So again, not the end of the world, but certainly not a good harbinger of what's to come. Software multiples and SaaS multiples have dropped dramatically since about 2 years ago, January of 2021. So about 21 months or so, where we hit an all-time high of multiples at 15 times next 12 months revenue, which is forward-looking, down to about 4.4 times recently. So, that's a 2/3 drop. Now, there's going to be certain sectors, which we'll see in the next few slides, which are holding up better than others. Application software in particular, there continue to be, many large deals in that sector, but multiples have come down from the high of 6.3x to about 4.3x, so down about 1/3. Cybersecurity is probably held up the best. Security is really driving the software infrastructure really around the globe. Here's a bunch of M&A large transactions on here that you can see, but again, overall deal count is down the last 3 quarters in a row, but valuations have held up there pretty strong, maybe down about 10% or so, from 7.3x in 2021 to 6.4x today. And then data center hosting and managed services, that's probably fallen the most. It's down to about 1.5x forward revenue. As you can see here, those deals have also declined from a numbers perspective. One of the reasons this has taken the hardest hit is that data center hosting and managed services often has a pretty significant hardware component to it, and hardware tends to generally be out of favor. So Colin, that's the update. Back over to you. If there's anything else I can do, please let me know.
Awesome. Thanks, JP. And yes, that's some data that looks bleak, but hopefully there is some optimism on the horizon for the entrepreneurs out there in the ecosystem. But appreciate you sharing that. Let's go to almost to our next panel. I'm going to launch another poll before I introduce our next speakers, and just understand in the next 3 months how many of you are exploring M&A as an option. So are you looking at M&A this quarter? Are you waiting? Are you fully looking into it, not ready yet, or just here to learn more? Let us know. All righty. Thank you for voting. This will help our panelists understand where you're at right now. Okay, I'm gonna end this poll, share those results. Bunch of people looking to learn more, and then the next batch is fully looking into it, and then some people are just not ready yet, which totally understand that. So thank you all for sharing. All righty, well, please join me in welcoming our next batch of special guests for our M&A strategy for early to mid-stage entrepreneurs panel. First up, we got David York, Global Strategy Partner at KPMG. We've got Luke Parson, Partner and Senior Vice President at Woodruff Sawyer. And we've got Jason Breen, Partner at Wilson Sonsini. Gentlemen, welcome.
Hey, Colin. Hey, everyone.
Great. Well, I introduced you by title, but maybe we'll just go quick round table. Start with you, David. Just a little bit about yourself and what you do.
Sure. Good morning. Good afternoon, everybody. Thanks for joining. I'm David York. I'm a partner in KPMG's M&A advisory services business. I'm based in Silicon Valley, and I spend most of my life helping our corporate clients with buy-side and sell-side M&A. Look forward to the discussion.
Awesome. Jason?
Sure. My name is Jason Breen. I'm a partner in Wilson Sonsini's M&A practice. I represent a mix of buyers and sellers, both in the software, technology, and life sciences space. Also looking forward to this panel.
Amazing. And then last but not least, Luke.
Hi, everybody. Luke Parsons here. Glad to be here. I'm a partner and Senior Vice President with Woodruff Sawyer. I lead the private equity and due diligence practice here at Woodruff Sawyer for our buy-side private equity clients. Woodruff Sawyer in general is one of the largest privately owned insurance and benefits and consulting firms in the country, and we spend about half of our time focused on the IPO space. So we are the market leader in helping startup and smaller private companies go public from a management liability D&O perspective. And the other half of our time is spent working with our private equity and venture capital clients on their buy-side engagements. Glad to be here.
Amazing. Well, happy to have all of you. All right, gentlemen, let's jump into these discussion questions. So as we just saw with JP, the markets and the M&A market has been a little rocky, to use his words. So I'm just curious on how each of your desks has evolved from the beginning of this year to right now in the M&A market, and what you think that means for the next quarter and the following quarter. So Jason, I'm going to start with you.
Sure. I think what we've seen is that buyers seem more cautious at this point. I think that we've seen that the markets and the ability to finance acquisitions and the interest rates have helped push that. I think we've also seen sellers trying to figure out where valuations are And, in light of the rising valuations for a prolonged period of time, people are trying to make sense of where am I at, both from a financing perspective and an M&A sale perspective. But the one thing that we're definitely seeing is deal choppiness, to use the same term. Deals are taking longer to get done. And so when people are thinking about doing an M&A transaction, they should probably be building in more time, both at the front end of trying to figure out who the players could be in an M&A transaction, but also to get a deal done.
Awesome. And speaking of valuations and finance numbers, David, how's your desk changed over from Q1 to Q3?
Yeah, no, I mean, similar to how Jason articulated, I think, Colin, we went off the back of, a really strong rebound post-COVID, certainly in tech volume. We were sold out as a practice for some considerable period of time. And then, the market has decelerated quite markedly, I think, over the summer and into the kind of fall period here. And I think similar to how Jason articulated, right, we're seeing, buyers being more cautious, right, being happy to kind of wait and see. I think we are likely to see some more distressed assets coming to market, and we are seeing some softening in terms of valuation expectations, which I think is going to help us in the end get some deals done, which I think is great, right? So, companies that were, looking at maybe post-COVID valuations because of their financial situation, are being perhaps forced into some processes. So I think that will help to unlock some business for us. But if I look through the outlook, I know we've got a question on outlook a little bit later on, but certainly I think through the winter period here, it's going to be challenging given some of the macro stuff that JP talked about. But I'm hopeful by kind of maybe early springtime next year, I think will be a bit better. But I think it's going to be a little bit challenging for the next quarter, if not the next kind of half, I think.
Yep. And nobody has a crystal ball, but there is hope. I love that.
Yeah, I mean, his six slides didn't make me too optimistic, but yeah, no, hey, look, everything is a cycle, and I think we're clearly in a down market here. It's just a matter of how long the down market kind of plays out, I think.
Yeah. And Luke, how has the insurance market and your desk evolved from the beginning of this year to now?
Yeah, I think obviously SPACs and de-SPACs took a lot of my time, a lot of my team's time. End of last year, beginning of this year, that obviously has fallen off a cliff with some new regulations that have come out. With the market being down, our IPO book is definitely a little less busy than it has been in prior years, obviously. But like JP said, when you're coming down from the literal top of the market, it is down, but it's still, relatively speaking, not that bad. I think it's going to get worse, as David and Jason mentioned. I will say the private equity community, the ones that have cash on hand and dry powder that they need to deploy, those firms are still fairly busy. The summer was very slow. We've been engaged on a handful of transactions here just over the past couple of weeks, trying to get deals done before the end of the year. I think we're seeing an uptick in take privates and divestitures from publicly traded companies that are getting hammered by the market right now. So that's a key item we're seeing. I think I would echo what David said. I think the next couple of quarters may be a little challenging, but it's going to rebound at some point, hopefully by spring.
All right. Optimism across the board. Jason, curious for our early stage entrepreneurs who are just thinking about the process right now, what are some of the main legal points that a startup and its board should consider when determining whether or not it's the right time to think about selling, regardless of market timing?
Yeah, so boards have a fiduciary duty, as many of you probably know, to on behalf of their stockholders and act in the best interest of their stockholders. When boards are thinking about whether or not to enter a process or potentially sell, there are a lot of things that they tend to consider. One of them for startup companies in particular is the size of the preference stack. I think that that's really important, especially in these types of markets where valuations may be down in sales, to really understand where you are in your preference stack. If you were going to do a deal at different levels and what that means for engaging management and really engaging and incentivizing your teams. Another is cash runway. And you see this particularly at a lot of board meetings these days, people raised a lot of money during the good times. How long that lasts is something that people think about, and whether or not, staying as an independent standalone company is possible. And then another thing that people start thinking about is, conflicts that may exist at the board, which is exacerbated by the first point where, the preferred may end up holding a lot of the cash proceeds at the valuations. And if there are conflicts, that just means that the board is going to be subject to higher standards. In these types of markets, especially in situations where there may not be enough money to go around to the common, people really weigh whether or not going through a full auction process makes sense. Should you pay a banker? Should we do that? All of those are really important facts for when doing these types of fiduciary duty analyses. So thinking about the way to approach the process at the early stages is really important, and will set things up for, whatever transpires afterwards.
That's super helpful. And speaking of, I guess, deals taking a little bit longer that a couple comments have already mentioned, David, what things do startups need to focus on when it comes to due diligence, even ahead of M&A conversations, because deals are dragging right now?
Yeah, I think, I spoke on this panel maybe 3 years ago, and I think I gave the same answer to the same question, Colin, 3 years ago. I think for me, there's a lot about being prepared, right? So, one of the things that can frustrate buyers, I think, and prolong the process is, sellers not being prepared with, kind of a basic set of data that they can provide to potential interested parties. So I think just making sure that you have, ready access to things like bank statements, right, business plans, management presentations, whatever. And it's whether you have a Dropbox file or some structure that you can provide, I just think gives the basics of getting that, sell side kind of artifact gathering in place is really helpful. That's one thing. I think the second thing is, not to underestimate the impact that an M&A process will have on the day-to-day running of your business. So again, I think just being prepared for the level of distraction and the level of, interaction you'll be required to have, and making sure that, hey, someone or you can continue to run the business, whilst you're going through a process or whilst you're preparing for a process. I think that's really important. And then I think if you take a half a step back from your business and just understand, hey, look, what questions am I going to be asked, right? So how am I going to be able to, explain the historical performance, any anomalies in, within the financials as people look at them? I just think, again, just put yourself in the shoes of the buyer community, recognize that, they are going to be forensic, they are going to be very detail oriented around, how you're running your business, how your business is performing. And I just think, sellers can get ahead of that and just be prepared. And that will help to mitigate some of the strain, right? It'll still be a strenuous process for sure. But I just think just being prepared, being thoughtful and being mindful in advance, Colin, is what I would suggest.
Awesome. Your response has evolved a little bit. So you're not just playing record on this. Luke, can you discuss how reps and warranties insurance works just in general, and how it's beneficial and when it's the right time to think about it?
Yeah, sure, Colin. Happy to do that. So reps and warranties in a nutshell is breach of contract cover. So the intent of reps and warranties for a seller is to replace the indemnification and corresponding escrow arrangements in the purchase agreement when a company is going to be sold to a prospective buyer. Essentially what that means is whenever a transaction happens, a certain amount of the proceeds called the escrow is held back at closing. Traditionally, usually it's 10% of the enterprise value of the company, just, in general averages here. 10% of the value, the enterprise value is held back for issues that could arise post-close where there is a breach of irreparable warranty. Under the purchase agreement, the buyer has recourse and can go and claw back that escrow amount. For a period of typically a year, 18 months, 24 months. The reps and warranties policy is designed to replace that escrow amount. So the policy itself is equal to the escrow amount. So say if it's a $100 million transaction from an enterprise value standpoint, the escrow that would traditionally be held back is 10%. Well, from a seller's perspective, that's 10% of proceeds I don't get at closing. So what the insurance community did was they designed this reps and warranties insurance product to replace that with an insurance policy. So a buyer will frequently take out a policy on a transaction. It allows the seller to walk away at closing with 99.5 and or 100% of proceeds versus the 90%. From a buyer perspective, it eases the administrative process. It makes the process go a little bit faster. And it reduces the time to negotiate because some of them are just going to be covered by the policy. So you don't have to negotiate a rep or warranty back and forth several times because it'll just be included in the policy. From a size standpoint, we are seeing the market come downstream a little bit, where underwriters, given it's a down market right now, there's not that many deals to be had. We are seeing reps and warranties underwriters interested in deals that are sub $50 million of enterprise value. Generally speaking, prior to this year, there would be little interest for deals that were less than $50 million of enterprise value. But theoretically, a reps and warranties policy, in my opinion, makes sense to implement on any deal. Call it from your $25 million buyout all the way up to your $1 billion plus. We've used reps and warranties on several de-SPAC transactions that are over $2 or $3 billion. So it kind of goes the entire gamut. And again, the whole point of it is to replace the escrow, allow the seller to walk away at closing with additional proceeds than they would have absent a policy in place.
Super helpful. Jason, from a legal perspective, we've talked about a little bit today on how deals are getting stalled. But what deal terms are getting some deals stuck, and any advice for founders on that front?
Yeah, I mean, I think that the first place where deals get stuck is diligence. And I echo what David said around being prepared, because that's something you can definitely get ahead of early, even before you're entering a process. And, asking, for a diligence request list from your counsel so that you can start preparing it, making sure you have things like invention assignment agreements available. It not only helps you in the process and allows you to focus on the important stuff, but it also allows you to look like you're delivering a clean company, which just makes the negotiations go faster. In terms of deal terms, indemnities definitely seem to trip people up the most. Disclosure schedules and the reps themselves tend to take a really long time. So be mindful of those types of things and understanding your business for purposes of the reps, and for the purposes of the indemnities, understanding what your board and what your investors will accept. Because, it may be that, some of the terms you're being pushed into, your board just would not accept. And we see this in a lot of deals, and then you get stuck when it ends up becoming a problem later. So making sure that you have visibility as to what the goals of the parties are really helps. And, rep and warranty insurance is a great way to help with that. Sometimes we see that there's still indemnities in these deals for things like fundamental matters, maybe pre-closing taxes, things like I own my shares, really fundamental matters. But, I agree that definitely helps with the negotiations and definitely smooths things over, because not only do you not have to negotiate the indemnities as much, but there's also a little bit less pressure on the reps, because, there's pretty standard ways that insurance providers will look at the reps. And so as long as you're able to make the reps for purposes of the closing conditions, and that they're a fair set of reps that insurers will accept, it does take some pressure off there too.
Super helpful. And somebody asked a little bit about more indemnities examples, but I think you cover that. And if you didn't, put it in the Q&A box and we'll get to it in the Q&A portion. David, to transition a little bit more on back to the finance side of things. So you talked a little bit about being prepared, which is obviously a good thing in multiple instances as being a startup, but how can startups appear more attractive to buyers and acquisition offers from just like a cash flow or balance sheet perspective? I
think the thing we have to think about as a seller, right, is, what is the value of your business to the acquirer? And then, I think that will then really help you to articulate that when you're in management meetings, when you're, when you're meeting with prospective parties. Because I think as a buyer, right, there are a number of investment theses that you can think about, and so, are you attractive because of your revenue stream? Are you attractive because of your cash flow, to your point? Are you attractive just because of the talent that you have in the organization? Are you attractive because you have a specific bit of niche IP that the acquirer is trying to get their arms around? And I think understanding that, hey, look, probably 50% of your business or so isn't so attractive, right? It's it's just run of the mill, operations that you need to bring product to market or what have you. But what is the key thing that the buyer is really focused on acquiring? And I think then articulating your value proposition around that and making sure that you're able to emphasize that. So, as an example, I think being able to paint a picture to management about what you can jointly do together. It's like, hey, if it's a corporate buyer, you have this big, ecosystem that you're trying to monetize. How does this specific component, for example, fit into that ecosystem? How will you be able to monetize faster? How will you be able to drive incremental growth in the market, take share, whatever? And I think if you're really clear about, hey, this is our value proposition in that ecosystem, and together, 1 + 1 is greater than 2. I think the more that, I think it enables you to keep a premium in your valuation, right? Because the value of your business. And then I think if you're on the buyer's table, right, it's then, okay, that really helps me to conceptualize why we're spending all the money on this acquisition, because I can see how I know my business really well. I can see how this niche plugin or this niche set of technology or this niche set of developers or whatever will really help to drive this engine of my business. And I just think you make the buyer's life much easier in terms of being able to bring that to life. Does that make sense, Colin?
Of course. And yeah, hopefully there's a mutually beneficial outcome on the end through the acquisition too. Luke, talking a little bit back to risk in insurance, how should startups think about risk when considering being acquired?
Yeah, it's a good question, Colin. So as David mentioned, there's myriad things that buyers are going to want to see during their forensic review and forensic diligence of your company as a seller. I'm not saying it's going to be I like to say it's a top of page issue. It's just a top of page 3 or 4. It's not the top of page 1, but insurance should be a priority. It's obviously not going to be the top priority, but as a startup is thinking about it, I mean, if you think about it, the only backstop to protect a company that's a startup or in its infancy stages, first couple of years through Series A, Series B, Series C funding, the only backstop that the company has to protect against losses is the insurance. And there are some situations where if an insurance foundation is inadequate or deficient or doesn't cover the correct things, it can easily bankrupt a company if a big loss comes in. Take cyber liability, for example. If a lot of software companies out there, if they're not thinking about cyber liability insurance correctly and they have a massive data breach, that could bankrupt a company fairly quickly. And it's something that can easily be taken care of by engaging with an insurance broker or partner that can act as that outsourced risk manager and has experience in working specifically with startups as they go literally from garage to IPO. So my suggestion would be to make sure as a startup, you're engaging with an insurance broker that knows what they're doing, has expertise in your industry and your size of business, and can grow with you as you grow, that can help you implement a solid foundation of insurance that can scale with you as you begin to scale. I'm not saying if you're a startup with $10 million of revenue, you don't need a $50 million limit for anything, but you need to make sure that your coverage is adequate. It's one of the things the buyers are going to be interested in. One of the diligence areas is going to be insurance due diligence. That's all my team does day in and day out. So it is an area that they will consider. And if it's not up to par, or it's not state of the art, or it's deficient in some way, the sellers are going to have to make changes once the deal closes post-close.
That's super helpful. At the center, we host authors all of the time. And sometimes I ask them, why did you write this book? And they say, well, I keep hearing myself say the same thing over and over again. So my question to the group, and I'm going to start with you, Jason. In each of your areas of expertise, what advice do you seem to give regularly around M&A? And what's going to be the title of that book that you haven't written, unless it's in progress? Oh, Jason, you're muted.
Thanks. So I'll give an answer for both the buy side and the sell side. For the sell side, my advice is at the early stages when you're discussing the LOI or the term sheet, and you may be granting exclusivity, make sure that you really like the purchase price that you're getting, because after you grant exclusivity, most of the time the leverage flips to the buyer, and the buyers, especially serial buyers where the leverage is a bit sided toward the buyer, they're going to chip away at that purchase price in two ways. They're going to chip away at it through purchase price deductions, and they're also going to chip away with it with risk allocation, and ability to take some of that money. So, if you don't feel great about the price when you're entering into exclusivity, just know that you may be even less happy with it after you're done through the definitives. On the buy side, I always talk to buyers about what's the investment thesis of the acquisition, and are we writing the contract in a way that meets that thesis? For example, if you're doing an acqui-hire and the deal gets completely contentious, you probably have blown up your investment thesis right off the bat, because the people are not going to feel good about joining the organization after a pretty contentious negotiation. Or thinking about indemnifications, and if a lot of the proceeds are going to the employee team, is that a good remedy? Because it's going to be really hard to make those claims if the employees are key to the investment thesis. And maybe really focus on diligence, because diligence is your real backstop, not the indemnity, because it's going to be hard to make a claim. So just understanding the purpose is really important.
That's great. David?
Yeah, no, I really liked Jason's comments there actually about chipping away at value. I think that's really, really sage. I guess maybe two things also. Maybe I'll do one on the buy side and one on the sell side as well. So I think on the sell side, I think it's really important that people are ready for the culture shock of being owned by, a different organization and potentially not being in charge anymore. I think I see a lot of, fairly early exits of, entrepreneurs from the companies from which they've been acquired, mainly because I think they struggle with, creating the right level of impact, building networks internally, just being absorbed and owned by a bigger entity. That causes, I see, a lot of friction. Even if you have some kind of earnout, I see that as being broadly problematic for entrepreneurs. Also, probably not a question for today, but so I think just being mindful and being honest with yourself, probably around what it's going to be like to be a kind of a person in the line, right, rather than a CEO. I think is important. And then I think on the buy side, the challenge I see still, and again, Colin, you could have asked me this question 3 years ago too, is people being able to realize the value of the acquisition. I see lots of fairly aspirational revenue synergy plans, and other kind of grandiose ideas kind of put out there by buyers about what they're going to do together. And I never fail to be a little bit amazed by the inertia post close, right? As businesses get distracted, they have other priorities, the next kind of shiny penny from an M&A standpoint comes along, whatever it might be. And I just think one area where we spend a lot of time as an organization is trying to help our clients, really realize the benefit of the transaction, right? So what are you going to do post-close? Who is going to do what? Who is going to be accountable? How are we going to hold people's feet to the fire, right? In terms of, generating the value that from the investment that we're making. And I still see it's an area that lots of organizations have, some considerable improvement to go in, right? I think that, and the secret sauce for me, clients always ask what the secret sauce for me is holding people accountable. So how do we put it in people's objectives so that people from the buy side feel that they are accountable for the success of the transaction? And that means not just getting it to the point of close, right? That means getting it through integration. That means getting it getting the revenue synergies and the cost synergies realized, and I think making it so that people feel the pain in their pockets in terms of the success or failure of that is probably the key, one of the key success factors for me.
Brilliant. Luke?
Yeah, my overall advice for the sellers or anybody at the conference here on the webinar, surround yourself with experts, whether that is insurance, whether that's legal, whether that's accounting, tax. There are you as the seller or you as the person that's founded your company, is growing your company. That should be your sole focus. There are other people whose sole focus is doing those other things that need to be done as part of a transaction process. My advice is to find those people early. Trust those people, evaluate those people, pick the best possible folks you can, and then rely on them for their expertise. You've got Wilson Sonsini on here, you've got KPMG, you've got Woodruff Sawyer. Between the three of our firms, we've worked on literally thousands of transactions. If you're approaching on the sell side or the buy side, you may have only, if you're in corporate dev, you may have only done 1 or 2 transactions. You may have never used reps and warranties on an insurance, on a transaction. On the sell side, you might be a seller who founded your first company, who's trying to grow it and sell it. You've never worked on a transaction in general. There are experts out there that can help you through that process and tell you exactly what to be done to set you up for the most success. And I would find those people and rely on those people. A lot of times it's kind of a pay for expertise. And I would say there are lots of folks out there who do deals and work on deals, but I would find the experts and then rely on those experts for their expertise.
Yeah, and I think just to build on that a little bit, I think that's a really good point. And I think that the ad that I would say is make sure those people have your interests at heart, right? So,
Yes.
Make sure that they are independent, make sure that, because I think if you're relying on bankers to help you with some of this stuff, then you're already kind of leading the witness in some way. So I think if, you can find independent advice that you trust and people that are, that have your interests at heart, I think that's important as well. But I completely agree with what Luke said there.
Yeah. Golden nugget. Just like any startup, team is important. The team facilitating the exit is just as important. Jason, in terms of IP, intellectual property, what's your advice on protecting competitively sensitive information through initial M&A discussions? We've had a couple of pre-submitted questions asking about, how do I know if this person who's interested in acquiring me is just trying to learn how I do it and then steal it? So any advice there?
Yeah, this comes up a fair amount, especially in the life sciences space. And people get very concerned about it. I mean, the first thing to do is obviously make sure that you have a good confidentiality agreement in place, which has a term of survival that makes sure that the information would be stale if it were to expire, because there almost always is a term, and buyers will push for that to be as short as possible. Sellers will push for it to be as long as possible. But, if you have a sense that it's going to be, 3 to 5 years for it to get stale, that's what you should be pushing for. Now, enforcement of NDAs and, how much people follow them is questionable, especially if you're this small startup and you're going against a big company. It's a pretty tough thing to enforce. So, I think you should definitely get it in place, but here's some practical advice as well. I think there are 2 things that you can do. The first is stage things. And, especially early in a process, what you provide is up to you. And especially before you're in the throes of things and you're into more fulsome diligence, that's very typical, and buyers will push you to get more information. But I think, giving them the information that allows them to make a fulsome bid is probably enough at that stage, and you leave things for later. Now, this is all a balance, because you also don't want to frustrate buyers, right? You need to make sure that you're providing the information timely so that they can get their work done, and you don't want the deal stalling out because you overdo it from a staging perspective. But you can provide redacted information, aggregated information, which would allow them to get a sense of things and then open the kimono a bit later. The other thing that you can do for particularly sensitive information, especially if there are antitrust concerns, is create a clean team. And usually a clean team is created through an addendum to your confidentiality agreement, where it says only these certain people are allowed to see this competitively sensitive information. And they only get, those are the only people that get access to those folders, and they can't share it with other people within the organization. And that does protect people, and it also sometimes protects buyers too, both from an antitrust perspective, but also from an IP perspective, because they don't want to taint their teams. So, again, you don't want to frustrate the process. Buyers will often push back on the idea of having a clean team when there isn't an antitrust concern, when it's just a business concern. But it's completely legitimate to ask for it. And, as I said, in certain cases, it may even be in the buyer's interest and they may not push back on it.
That's solid advice, but a lot to think about there. David, you've been on both sides of the table and have done a ton on, I'm sure, due diligence from the buy side. So from the buy side perspective, what do early stage entrepreneurs typically miss when preparing due diligence?
Well, so I guess there's the kind of mechanics of preparing for the transaction or the process, right, which I spoke a little bit about earlier. And I see an enormous amount of variability in people's states of readiness, right, which, as I mentioned at the start, can kind of prolong the transaction, a lot. So there's the kind of mechanics of, are we set up? Are we ready to go? Do we have all that kind of ducks in a row, etc. And then, as I mentioned during one of the other questions, Colin, I think, hey, do we understand the investment thesis? Jason mentioned it, right? So do we understand the investment thesis of the buyer? And are we able to articulate our value proposition, and our kind of strengths as an organization around that investment thesis? And again, I see lots of people who, are very excited by the potential sales process, right, and are happy to sit in a room with prospective buyers, but probably don't fully understand, why the buyer is really buying them and are not able to fully articulate that kind of back to them. So I think if you think about one of KPMG's value adds, just as a plug here, we provide a lot of sell side services as well. A lot of it is around process, right? So helping our clients to get a business plan, Q&V, whatever, to get them ready for a process. But a lot of it is around how do we articulate the value of what the buyers are going to be looking for. So how do we make sure that we understand, hey, this is our product market fit, right? This is the market in which we are. These are the profit pools that we're addressing. This is the exciting kind of growth in this market. This is how, we have high barriers to entry versus our competitors, et cetera, et cetera. And I just think being very thoughtful around, hey, this is why we are great as a company, and this is why you should want to buy us, and this is why there's going to be a premium in the market for what you're going to buy. I just think, there's a lot that's, that sellers can do to make themselves more attractive and frankly, to increase the valuation that they're going to be able to get. So again, I would think about it through two lenses. One of just the practical mechanics of, getting into the market, right, and being ready and having everything available, but then more importantly, what is the strategic articulation of the value of the business?
Yeah, I love that additional layer on just investigating why they would do it versus just like, is this a good deal or not for them? That's great advice. Luke, you also work with a lot of corporates and sponsors on the buy side. So how can our founders learn from your experiences working in the buy side due diligence process? And what do early stage companies typically miss and get wrong from your perspective?
Yeah, great question, Colin. I think the main thing that we tend to find in the majority of transactions that we look at from a buy side perspective during the diligence process is there is an adequate foundation of insurance in place. They have the standard coverages. The main deficiencies we find are that the coverage is it's not state of the art. There are several deficiencies or gaps in coverage, or B, the company is not insuring one or many of its key risks for a cost perspective. I say this after a couple hundred years in operation. The insurance industry in general is somewhat of an efficient market. So if something is more expensive than something else, there's a reason for that. For a consumer goods company, for example, your main source of expense from an insurance standpoint is probably going to be product recall insurance. It's going to be very expensive. But a lot of companies won't buy it because it's expensive. But again, that's one of those situations where if there is a massive recall for a product, that could bankrupt the company. Same exact thing on the cyber liability side of the equation, which is a ridiculously hard market right now. And a lot of buyers are spending a lot more time looking at cyber liability controls in place, how IT is structured, where the security measures are. A lot of times we will find that a software company, for example, that has potentially hundreds of thousands of files and person identifiable information on their servers and is processing those, they don't have an adequate cyber liability program in place. They might have a cyber liability program in place, but it's not adequate. There's lots of deficiencies and things like that occur. So what part of our job is on the buy side diligence side is to uncover those gaps and help the buyer then implement fixes for those gaps at closing, or purchase new policies as a part of closing to protect those gaps on an ongoing go forward basis.
Love that. Super helpful. All right. Well, we're almost here for Q&A, but I got a couple more questions for you, gentlemen. So I know JP's market update was, for lack of a better word, bleak. But what do you think the outlook for M&A market over the next 6 to 12 months? So I'm not talking quarters. And David, you talked a little bit about hope, so I'm going to start with you.
Oh no. So I couldn't get off mute then, Colin. So I think, hey, I think tech has always been pretty resilient, and I hope that, tech will continue to be the kind of standard bearer, right, when it comes to, being impacted less and rebounding fastest than the other sectors. I say that through my fairly parochial, kind of TMT view, I guess. But I think, hey, it's going to be a rocky period, I think, for sure. I'm sure some markets, like we saw through COVID, will, have deeper troughs, right, than tech will. But I think if we're sitting here this time next year, I'm sure the market will have rebounded by then. I think the market could probably have done with a little bit of correction anyway. So I'm sure those of you with 401ks on the call probably don't agree. But I think some of those numbers looked pretty racy. And I think if if this is as far as it falls, or we've got another quarter, maybe it falls just a little bit more, and then it we get into a more steady state, growth trajectory, then I think that would be a kind of good outcome. If it's a 24-month bear market, then that's obviously going to be more problematic, probably for everyone on this call as well. But I'm optimistic. I think for me, there's a little bit of macro in Europe that's not helpful, right? So all the stuff in the UK is obviously challenging. All the stuff in Ukraine is clearly challenging. Inflation is challenging still, but I'm hoping that, over the next kind of half a year, then some of those macro things will correct a little bit. And then, I think the market will hopefully be pretty resilient and bounce back pretty quickly. Fingers crossed.
Yeah. And one of the things that we're looking at is what the venture early stage entrepreneurial ecosystem looked like 08, 09 compared to what we're about to look at over the next 12 months. So we're, of course, cannot predict historical trends, but of course, just interesting thing to look at. Jason, next 6 to 12 months.
Yeah, I mean, I think that we're already seeing, maybe it's a year-end bump, and there's more discussion of deals. Whether or not, those deals end up happening, we'll see. But, at least in my experience, deals end up happening. It just may not be the deals people were expecting. So I think that once there's a little bit more stability in the markets and, the global outlook, I think people are waiting to see what happens right now, but it's not going to make it so that deals don't happen. I think that there just may need to be a reassessment of what people's expectations for those deals are. We're already seeing the dreaded earnout discussions starting to help to bridge valuation discussions, which, from a deal certainty standpoint and a deal effectuation standpoint, makes deals more challenging to get done and, increases the chances for disputes post-closing. But it is a way that we're starting to see people bridge those valuation gaps and the uncertainty in the deal, the current environment.
Love it. Luke?
Yeah, I think, the summer was slow, like I said earlier. As Jason just mentioned, there are deals getting done. We've seen a significant uptick in deals just in the past month alone. I think we'll continue to see that during the normal Q4 rush. I think the public markets will continue to struggle with everything else going on macroeconomically for the next quarter, maybe 2 quarters, 6 to 9 months. But when that happens, we're seeing valuations come down, as everybody mentioned before. The private equity community tends to like that. I mean, its valuations were way too high, and a lot of private equity firms couldn't be as competitive on those valuations when you had the SPACs and de-SPAC market. as the public market goes down, the private equity community in general has $4+ trillion they needed to deploy of dry powder. So I saw this question in the Q&A. I can answer as part of this, but it's kind of it's a guessing game with interest rates. Private equity is going to use debt. They're going to have to buy leverage. The cost of that debt is increasing on a monthly basis. So they're trying to figure out, when can we afford to buy this company versus when is going to be more expensive. We can't hit our internal rate of return we need to hit on the investment. So I think Q4 will be busy. I think Q1 we'll see a pause in the private equity world. But I'm still bullish on the market simply because there's so much dry powder out there that needs to be deployed.
Love the hope and optimism out there for the future. I know I already covered a little bit about sort of your book title, but if somebody was going to dial into the 30 seconds of your talk, what's one key takeaway from each of you that a golden nugget, if you will, for the attendees today? It's, I guess, their quotable LinkedIn quote. So Jason.
Sure. I think M&A processes are a slog to get through, especially for founders and management. And, you're going to be wearing many hats and pulled in a lot of different directions. Be patient with it. It's a process. We go through this every day, so I understand that. And we try to advise clients about it. But to echo an earlier point, trust your advisors, lean on them to help you. We've seen a lot. We can help with these things. So don't feel like you're in it alone. Really lean on those people that have the experience to get you through it, because, there are ebbs and flows to these deals. Especially in diligence, it'll feel like, how can there be more questions after we've gone through 30 pages of diligence requests? There are always more questions until you get to the end. Just to dispel you of any misconception on that front. It's those types of processes. But at the end of the day, it can be transformative for your business and your investors. So, just trust that process.
Love it. David?
Yeah, no, Jason, I think that's really good advice. I think the thing that I would offer in addition is, perhaps the old Boy Scouts motto of, be prepared, right? And I harped on that a little bit at the start. I think, you can take a lot of pain and a lot of friction out of the system by, being thoughtful, being measured, being patient, and being prepared. I think that will help, especially in this market, right, where people will probably look for, reasons, to Jason's point, to chip away at valuation or to elongate the process or what have you. I think the better prepared you are, that will stand these folk on the line and others in good stead.
Always be prepared. Alrighty, Luke.
I mentioned earlier, I'll say it again now. Your job as a seller is to grow the business. That's what you're focused on. Your business better than anyone, and that's great. That's why you're doing what you do. My one nugget of advice is evaluate advisors, understand what you don't know, find the advisors that get your business, and as David said, have your best interests in mind, and then trust those advisors to advise you and do their job accordingly.
Great. All right. Well, gentlemen, we are right at the mark where we're going to jump into our live Q&A. So for those of you on, if you haven't dropped a question into the Q&A box at the bottom of your screen, do so now. We'll try to get to them all. Luke, you touched base a little bit on the PE firm, but I'm curious if Jason or David have anything to comment on this. So PE firms with dry powder just trying to do deals before interest rates go higher? David, Jason, any comment on that one?
Yeah, no, I'm always a little bit interested in the dry powder commentary, right? Agnostic, perhaps, of interest rates, but KPMG, we create a private equity report that goes out to the partnership every month, I think, where we talk about the ever increasing amounts of dry powder kind of in the system, and it feels like we've been talking about that for, I don't know, 2 years or 3 years, right? It's like, we're waiting for this tidal wave of dry powder to be deployed. And I guess I just don't, it's interesting. I don't know whether Luke has a perspective on whether there is an end state for dry powder, right? Whether it's just going to kind of accumulate. What, I don't get a feeling that there's suddenly going to be a trigger event, right, where there's going to be this big deployment of dry powder out in the market. I don't know, Luke or Jason, whether you guys see that differently from your standpoint, but I guess I've never really seen it in action.
Luke, Jason, any comment?
Yeah, I think my view is private equity is always strategic in what they do. If the markets are showing a lot of bargains, they're going to be extremely active in this type of market, and they'll deploy it. If they don't see that value and interest rates are high, and there's a risk to their return, then they'll probably stay on the sidelines. Probably not overly helpful, but it's private equity understands the markets better than most and understands the return profile of these companies. So I feel like as soon as it would make sense, they deploy the capital.
Luke?
Yeah, I agree with what David and Jason said. My only caveat would be at some point that amount of money is going to have it already has a giant bullseye on its back from an SEC standpoint. And Gary Gensler's made a couple of comments about private equity. So I think as the dry powder accumulates, as fees for the private equity firms accumulate, I don't think there will be a light switch by any means or one event, but I think passing regulations at the political level could have an effect longer term on timeframes or what have you. And I think that could have a material effect on it as well.
Great. All right,
Colin, maybe I'll take there's a question on the consulting firms laying off people due to softness in M&A and recessionary trends, and maybe I'll take that. I guess that's probably right in my wheelhouse. So the good thing is, I guess, about most consulting firms is they are multidisciplinary in approach. And so, in our business, we obviously have a kind of counter-cyclical business around restructuring, right, and helping companies to drive performance improvement. So I think what we see is, a shift in resources and a shift in focus when M&A markets are soft and when that's a bit challenging into some of these other areas. So I think if you're, just an M&A advisory business, you're probably, you should buckle up for a kind of fairly rocky 6 months or so. But I think in big firms like KPMG, and I'm sure for the guys on the phone here as well, I think we are so diverse, right, in terms of what we're able to offer to the market that, it would take a really prolonged period before we saw any impact like that.
Great. Thanks, David. Luke, question for you, because you were spending a ton of your time on SPACs over the past 2 years. Is there a lot of dry powder trapped in SPACs? And do you see de-SPACing M&A coming back to previous levels?
Yeah, so the dry powder is not technically, it's not trapped in the SPACs, kind of two separate things, in my opinion. You've got one publicly traded company, it's a SPAC, and you've got the private dry powder on the private equity side. But I think in terms of these SPACs, I don't see it coming back for a while. I mean, I think in 2021, Woodruff worked on 80 to 90 plus SPAC IPOs, and my team worked on probably 30, 35 de-SPAC transactions from a diligence perspective. So far in 2022, we've done 0. So I think it's a huge 180, and I don't see it coming back as much. I think we're going to start to see a lot more SPACs liquidating and ceasing operations and returning that money to the investors.
All right, Jason, can you tell us a little bit more about the dynamic of negotiation and due diligence between acqui-hire versus just outright purchase of the company?
Yeah, I mean, acqui-hires are structured in different ways. Typically, sometimes they'll be a purchase of a company, the company itself, but often they're done as licensing transactions where they're licensing the technology and then hiring the team of people that they want. Sometimes it would be done as an asset deal with the hiring of people that they want. So just from the perspective of structure, that definitely is different. In those types of deals, you often see less purchase price and maybe more being pushed toward retention, especially if those people are, there's a big preference stack that's sitting in front of the common stock, so the team's really not getting much in the deal. But those are certain things that are different about acqui-hires as opposed to just a general purchase of a company. Sometimes it's a mixed transaction, so it's not necessarily an acqui-hire. It's the team is really critical to the thesis, but there's also a business or a technology add-on that could end up being important as well. So those tend to be more looking like a normal M&A deal, maybe with more retention type terms and retention payments.
Super helpful. I'm going to offer this one up to whoever thinks they want to handle it. But this is an interesting question. There's a couple questions here around brokers. So from the sell side perspective, what's some advice around brokers? David, Jason, Luke, any comment? Great. We'll move on. Hey, I gotta ask it because they answered or they asked it. Let's see. We've got another question here. Can you talk a little bit more about a spin-off or acquisition of a business unit of a company? Jason, you were talking a little bit about it, but David.
Yeah, sure. I can take that one. The spin-off or acquisition of a division tends to be one of the more complicated deals that we do, because you have to figure out how you take that business and remove it from the other business and still have the continuity. So, especially if there's IP overlap or there's personnel overlap, you have a lot of things like transition services agreements. You have to figure out how to extricate the business. Maybe some of the supply agreements are across a bunch of different business units within the company. How do you divide those up? So they tend to be pretty complicated deals to get across. And also just thinking about it from the buy side, understanding kind of what you're willing to live with. Are you really just extracting yourself from this completely, or are you willing to stick in it for a while? Like I did a carve out deal where the transition services were like 2.5 years, where the buyer continued to essentially operate the business for a long period of that time as it transitioned over. So, understanding what you're willing to do at the beginning of those transactions is also very important.
I think, Colin, one thing I would make a comment on with that is with a carve out or divestiture or take private, don't get me wrong, a small portion of the deal, but a portion of it nonetheless needs to be focused on insurance. There needs to be an entirely new property, casualty, managed liability, employee benefits, 401k. All of those things have to be set up either at close or post-close, depending on, as Jason said, the terms of the TSA. So it's just one thing to keep in mind. And it's one more kind of complicating factor that makes those deals a little bit more complicated than others.
Thanks, Luke. David? You look like you were going to add something.
No, I was. I mean, I don't think I have anything additional. I think they are very interesting transactions. They are more complex, as the both here have mentioned. And I think, again, if you think about from a seller's perspective, if you're carving out, a relatively small, insignificant part of a big organization, which is often the case, often that can be extremely distracting, right, for the kind of host organization, given the size and the value that they're able to realize that. I think there's, all the things we spoke about here, preparation, again, being very important, patience being very important, even more so heightened, I think, in a kind of carve-out type situation.
Yeah, and on the buy side, diligence is even more, it's always critical, but it's extremely critical, because if you don't end up getting all the assets that you need, or you don't know about a service that's being provided internally that you don't have coverage for post-closing, that could make the integration or the go-forward nature of the business totally different. And so really a focus on diligence. When you're buying a company, at least, you figure, well, the business has been operating and I'm getting everything that's in the business. So as long as you check the box that founders or others don't have rights in the assets and whatnot, you figure you're probably getting everything, and you're trying to find the problems in the business. With a carve out deal, on the asset side, the contract side, you really need to be careful.
Super helpful. Oh, we're almost at time, but I want to end on a high note with one last question. So I know we aren't talking about the mechanics of valuation here, but this is an interesting question from actually an alumni from one of our programs. Hi, Earl. So in terms of what JP was talking about on valuations and just market dynamics in general, there was a lot of high valuations in 21 and a lot of large asset transactions. So, but what does that mean for the next couple of months, next year? So like if your last valuation was, let's say 30 million bucks in Q4 21, is that a starting point or is the valuation reset for your M&A discussion?
Yeah, I mean, I would just think about, what is realistic in this market, right? I don't think previous performance is any guide to the future, right? So I think, hey, look, how would I value this business today? And I wouldn't, it's very difficult to get rid of that historical anchor. I know, psychologically that's very challenging, but I think that will help, right, to free up a lot of angst if people are realistic, right, and have at least a soft reset on their valuation expectations. I think dragging a historical anchor behind you is probably not helpful.
Amazing. Gentlemen, any other additions? Great. Well, thank you so much, Jason, David, and Luke, for sharing your insights and wisdom with our attendees today for the sales side. Really appreciate all of you. For those of you still on, we're about to jump into a quick break, but many of you have asked, how do I get a meeting with these experts? So we're going to launch a quick poll right now just to let us know if you're interested in meeting with one of our partners from Wilson Sonsini, Woodruff Sawyer, or KPMG. But we are going to take a quick 10-minute break. And then after that, we're going to jump into our growth through acquisition panel, the buy-side overview. So we're going to return at 10:25 a.m. Pacific on the dot. But gentlemen, thank you so much for sharing your expertise. I sure learned a lot, and I'm definitely hopeful that our attendees did. So thanks for coming back, David and Luke and Jason. Appreciate you. Everyone, thank you so much in the chat, fellas. You did great.
Take care, everybody.
All righty, we're going to jump into a break. See you in 10, everyone. welcome back. For those of you just joining us, we're going to open up for live Q&A near the end of the session, so please submit those questions for us in the Q&A box at the bottom of your screen. If we haven't gotten to yours, we'll try to get to them all. So as you settle back in, we're going to launch a quick poll just to learn a little bit more about what you're looking to learn in this next session. So how many acquisitions are you planning the next 3 to 6 months? 51% of you are looking to learn about the buy side today. So curious on where you're at. All righty, these poll results are rolling in. Thank you so much. All righty, I'm going to end this poll in one moment, but appreciate you voting. All righty, I'm going to end this poll and share those results. Looks like many are holding, but 53% of you are looking at 1 to 3. So that's a good outlook for the startups in our ecosystem. And on to our next topic. As I just mentioned, the buy side. Our next panel is on growth through acquisition, the buy side overview and insights. So without any further delay, please join me in giving a warm welcome in the chat to our special guests. We have our moderator, who's Raghu, the director at National Grid Partners. We also have Andy, who's a partner at KPMG. We've got Emily, who's a partner at Woodruff Sawyer, and we have Mark, who's a partner at Wilson Sonsini. Welcome, team. All righty, there we are. Hi, Raghu. Hi, Mark.
Hey, guys. Hey, Colin.
Hey, Colin.
Looking forward to this. So Raghu, over to you.
Awesome. Thanks for having us. This is a long-standing partnership, so really thankful for this. It's always good to jump on as a sell-side person and get feedback from the buy-side guys. So this is helpful. I know a lot of entrepreneurs want to know some of these details. So a little bit about myself and National Grid Partners. This is the CVC arm of National Grid. So depending on where you are in the world, you're probably getting your electricity and gas from us. So we are a gas and electricity utility in the Northeast in the UK. And mainly we invest in mid to late stage energy transition startups, basically. So good to be here. Can we have Andy go next and introduce yourself?
Great. Thanks, Raghu. My name's Andy Gersh. I'm a partner with KPMG in our deal advisory practice. I've been with KPMG for about 30 years and been doing M&A in the software, semiconductor, and services space for about 25 years.
Thanks, Andy. Welcome. Emily, you want to go next?
Sure. Hi, I'm Emily May. I'm a partner at Woodruff Sawyer, which is a full-service brokerage firm, and I head our transactional insurance unit, which is rep and warranty, litigation, tax opinion liability, and I've been doing that for the last 5 years.
Awesome. Mark?
Hey, thanks, Raghu. I'm a partner here at Wilson Sonsini. I head up our East Coast M&A practice, focused mostly on private company targets in the technology space, and I also do a lot of cross-border work with the UK and Europe.
Awesome. Welcome, everybody. So maybe we can quickly go around. Mark, maybe starting with you. Just given everything is given the macro changes. I don't think we can see beyond a week, but can you put in perspective, what's been happening in the last 6 months? How have things changed, or maybe haven't changed? Just to frame the conversation for the audience.
Yeah, happy to. So what we've been seeing, I would say Q1 was sort of a continuation of 2021, still pretty busy. Things started to slow down in the second quarter of this year, and the third quarter has been much quieter. I think there's a lot of macro trends with rising interest rates and supply chain issues that are distracting buyers. I think there's less competition from things like IPOs and de-SPAC transactions. So the market overall feels less frantic by a lot than it did in 2021. I think we're starting to recover from some of the hangover from last year. All parts of the market were tested really hard, and you still see some of that in terms of regulatory and governmental responses on these things. Deals are generally taking longer. And I think there's some uncertainty around, pricing and valuations.
Makes sense. So we can dive a little into a few of those, but anything to add, Emily? From
sure.
what you're...
I mean, much the same, definitely taking longer. I think every deal that we have is probably taking at least twice as long as it would have done last year, which is interesting. And then also I think from a size perspective, I agree. We're seeing a definite uptick starting last quarter and hopefully continuing through year end. But it's definitely on the sort of smaller side of medium. Whereas last year, I think we saw a sort of an average deal size that was overall higher.
Super. Andy, anything else? Maybe are there certain end markets that are more active, less active?
Yeah, there's a couple of trends that we're seeing. So we're seeing quite a bit more activity on the semiconductor space than we've seen for a while, which is surprising, just given semis have been in a sort of downturn for a couple of quarters now. I'm also seeing more activity on the what I'd say mid-market corporates who were really priced out of the market for probably for the last year or so, except with very sort of opportunistic buys. Because there's been more moderation on valuation, I'm starting to see more interest from you could say the tier below a Google, Apple, Amazon of the world. The other trend that I think is interesting is just the number of very large private equity funds that they're reaching the end of their life cycle on some of their investments, and I've seen a number of sale transactions being terminated because they're just not getting the valuations that they hoped for, and I'm seeing a lot more sort of continuation deals and continuation transactions arising in the last sort of 6 months.
Thank you for that. It's good to see semiconductors are coming back in some sense. Just sticking with you, just to get a sense of the amount of activity, can you share how your sort of bandwidth has changed in the new year? Based on is M&A taking more of your time? Are there other things that you're more active on? That'll be helpful.
Yeah, so we're seeing a slight change. So what I think if you look at the overall deal volumes in the US, deal volumes are down about 35 to 40% in the US. I think it's 35 globally or 30% globally, 40% in the US. And for us and for Emily and Mark, I suspect it's the same. Our business is volume based rather than maybe deal price based. You're looking for the number of activities. So there's been a definite slowdown in the volume of work we've been performing particularly on the buy side. We are seeing the trend that we've seen in the US is just the percentage of transactions coming through from sponsor deals and private equity deals is much greater than it was a few years ago. And the trend that we've seen is that when they're looking to exit some of those investments, they're doing a lot more sort of sell-side diligence from accounting firms. So our overall volume has been pretty stable actually in the last 9 months because we've just seen the shift from almost buy-side to sell-side transactions.
Is there some sort of a flight to quality, if you will, or is it that's not necessarily changed? There's definitely a flight to everything's got a price. So it might not be quality at $100, but it might be quality at $50. So there's a M&A is a confidence-driven activity. So as the stock market goes down and you've got more volatility, notwithstanding it shouldn't actually have an impact on the valuation. Interest rates aside, people feel less confident to undertake M&A. So we're seeing that reflected in the price that buyers are willing to pay. So there's a lot more. I think to Emily and Mark's point about deals are taking longer. They're taking longer because there's just maybe more thoughtfulness around the pricing and more negotiations around the underlying terms there. Got it. Thanks for that. Talking of underlying terms and sort of the negotiation part. Emily, can you reflect a little bit on how maybe the reps and warranties have evolved maybe within the last year or so?
Obviously, I think there's an increase in discussion around a termination due to HSR, or I think there's a greater emphasis and concern about the current administration's interest in deals and how much they're going to get involved in them, and whether the sort of slam dunk HSR, oh, just wait a month and it'll all be fine, doesn't seem to be the case anymore. So I'm seeing a lot more debate around that and how that's going to be handled, the sort of hell or high water clause. And then, as Andy said, there's more debate on valuation. And so we're seeing a lot of deals that will start and then they'll stall out. And then there's a business issue that's come up. And they're it's essentially a reevaluation of the valuation. And so we're seeing purchase prices changing a lot more over the course and changing to more earnouts. I'm seeing a much higher percentage of earnouts rather than just sort of cash up front. And I would say those are sort of the two main areas. In terms of the reps themselves, I'm not seeing, even though you could argue that it's I wouldn't say it's a buyer's market, but I'm not seeing sort of more punitive or extreme reps and warranties being given. I think there's an increasing scrutiny on suppliers and customer contracts, because that's certainly where we've seen a lot of claims coming up. And I think everybody's very aware that in a changing economy, those things can sort of come home to roost. And also, when we can talk more about it, but there's just generally a greater, it's a finer tooth comb that is being gone through for everything, I think, in the diligence process.
Got it. I think the pricing piece will be interesting to just dial down a little bit. Maybe I'll come back to you on it. But Andy, any thoughts on, from a buyer's point of view, what's the key driver for valuations, pricing? How has it impacted in the last quarter or so?
There's two elements there. One is interest rates and just the cost of capital has increased. So we're seeing overall multiples change quite significantly. There's still a few sort of edge cases where you might see it 10 times plus revenue, but by and large, if you're profitable or you're maybe more of a stable business and you're being valued on EBITDA, then we're seeing, let's say multiples may have been 10 times or 12 times 9 months ago, coming back down to that 8 to 9 range. But I think it's there's still too much uncertainty around interest rates, and is this going to be an extended period of higher interest rates relative to the last few years, or is it maybe more of a temporary, and by temporary maybe 1 or 2 years, so maybe less of an impact.
Got it. And is there maybe a bias towards profitability or indexing more for profitability versus sort of revenue growth itself per se, which is the obvious one, but.
Yeah, I think the phrase is dash for cash, both in kind of business operations and cash on your balance sheet. So I'm seeing on the corporate side, buyers are facing much more scrutiny from the street around free cash flow. So I've got an interesting situation just now where there's a timing issue around deferred revenue, where the sellers collect a lot more cash in advance, and so the buyer is going to be reporting higher revenue, but without the cash flow to support it. And there's just some concerns and some thoughts around how you present that data to the street. So there's definitely a much greater emphasis on free cash flow than I was seeing about 12 months ago, 12 months ago.
Got it. Thanks for that, Mark. Just to switch a little bit from the valuation side, which is I'd love to have a separate session just on the valuation itself. But on the sort of legal aspects or the sort of deal dynamics, how has that changed? Is there more antitrust concerns now versus, say, even 6 months back? We've seen a couple of like ARM and Nvidia and a few other. We saw something, Facebook doing something, but can you just share some perspective on how that's being a factor in the last maybe couple of quarters?
Yeah, absolutely. I think the regulatory space is really sort of the big story in terms of legal terms for the year. Antitrust, I think, is the bigger of the two, but I wanted to touch on foreign investment regimes as well. On the antitrust front, it's been very interesting, and I wouldn't say you can't really make a blanket statement about it, because I think for some people it's not very different, right? You can't get early termination anymore, so you can't be done in 15 to 20 days with your HSR review. Maybe it takes 30. Or maybe because the agencies are still overwhelmed, your deal doesn't land on somebody's desk until day 28, and they might ask for a little more time, right? So on the margin, there's a little bit of impact on you. But what we're also seeing is, a lot of skepticism of big tech. And if there's the possibility that a sort of, I would say, a less common angle for review, typically increase in prices was a big focus from the agencies. And we're seeing them look at less common things like data aggregation, decline in innovation, lower service levels, harm to employees, broader, considerations that can really kind of change the analysis on what does that look like. The data aggregation piece is kind of interesting, right? I mean, if you're looking at a company involving a huge, data lake with petabytes of data, that could be, millions and millions of dollars, and economists and lawyers trying to understand what that is and get the agency comfortable with, one company controlling that much data. And so it's I think for people that are impacted by that, it can be very different, right? A lot less deal certainty. For others, it's, kind of on the margins. And so it's an important conversation to kind of piece out, what your deal looks like in that context. The other thing I'd touch on is, a couple of years ago, the U.S. Committee on Foreign Investments got sort of beefed up budget and expanded scope. And what we've seen is a lot of countries around the world have put their own kind of foreign investment regimes in place in response. And not all of those are kind of fully fleshed out on details. And so you can run into issues with cross-border deals pretty easily, in part because some countries got rid of the dollar thresholds during the pandemic. And so, we had $100 million deals, held up over a 2-person lease,
I like a reverse Sisyphus war, if you will. Yeah, go ahead. Sorry.
It's been very interesting. Our national security folks, who are the ones who deal with that, generally look pretty stressed when I talk to them. I think on deal dynamics, I'd echo what Andy and Emily said. Cash is really important. Some useful anecdotes. We've seen a couple of deals where, the definite rise in stock deals, but deals where the seller didn't have enough cash to pay some pretty significant transaction expenses. And some buyers have taken the view that, look, cash is a lot more valuable than the stock we're going to give you. And so rather than just a dollar for dollar deduct a purchase price for those unpaid transaction expenses, they're thinking about 2 to 3x premiums on the cost of that. So cash is definitely king, as Andy was saying.
Interesting. Thanks for that. Again, like, these are so germane topics. We could probably spend like half an hour just on each of them. I do have a question from an attendee, and folks, please, you can access the chat and post your questions on the Q&A thing on Zoom itself. But question is, due to HSR, are you seeing more demand for less than 50 million type deals? I actually don't know what HSR means, but maybe one of you can jump in. Mark,
yeah,
maybe?
Why don't I take that one? Happy to have others jump in. So the filing thresholds for whether or not you need to make an HSR filing, generally from a deal perspective, it's around 100 million. It's adjusted for inflation each year. So, we'll expect it'll go up. It can be a little more complicated than that because there's also tests around the size of the parties. I don't think people think about deals as is it going to be, I'm going to do a small deal because bigger deals are going to have an antitrust problem. I think you'd only do that if you knew you were in a market that any deal was likely to get scrutiny. But the important thing to remember is that just because you file or don't file doesn't mean that the agencies can't come after you later and say, we think this is a problem. You have to go divest this. So I don't see that as a big driver for decision makers.
Got it. Any other comments on that, Emily, Andy?
No, I mean, I'd agree. I don't think that's, while it may be frustrating that the regulatory environment is more cumbersome right now, I don't think that makes a smaller deal more attractive. I think there are far more bigger economic considerations.
Awesome. Maybe the last one on the pricing, to Emily, I think the reps and warranties, insurance, can you touch a little bit on it? Has it gone back down? Why? Trends around that?
Sure. So the rep and warranty market is really helpful as a canary, if you like, in the mine, because there are only 23 markets. So they're very quick to respond to changes in M&A activity. Pricing towards the end of last year was dreadful, and it became a very hard market, our very first hard market. And it did not take long at all for in the new year for that to plummet right back down to where it had been before. We also have seen a greater interest from underwriters in sort of diversifying their product offering. We've been doing a lot of work on new product development, specialist products for small deals, specialist products for VC, specialist products for music licensing. So everybody's trying to broaden the revenue stream because pricing has gone down, but also at the end of last year, because pricing had got so high, people hired a lot more staff, more capacity came into the market, and then deal activity, dropped dramatically. So we have a lot of people with a lot of mouths to feed, looking for ways to widen the opportunity for that particular type of insurance structure, which has been interesting. And I think we will not see a dramatic change, even if we see a dramatic increase in deal activity, because we have this overcapacity and people have overhired. And I think it's also interesting because last year, I think more policies were sold than in several other years combined. And by definition, that means there will be more claims than ever before, right? More policies, more claims. And also going into a down cycle, as companies start to struggle, there is definitely a tendency to look to see if anything can be recovered from insurance. So even more pressure on claims. Normally, in a straightforward market, that would drive premium pricing up. I don't think that's possible in this market because there is still so much competition. I think there is room for deal flow to increase, and I think there is room for claims to increase before it actually impacts sort of premium numbers. And I think what we also saw at the end of last year is there is a point at which rep and warranty insurance doesn't make sense financially, especially for the PE buyer. And we saw, and to be honest, my gut is that's around 5%. We saw people going naked, both in terms of we won't buy the rep and warranty, but we also will have a zero seller indemnity structure. So they were just taking that risk themselves when pricing was above 5%. So I think we've sort of discovered a ceiling on pricing. And right now we are much lower than that ceiling. We're I'm even seeing sort of sub 3% rate online. So I think that's going to carry on, certainly for the rest of this year, and I imagine for the rest of most of next year. And honestly, when I talk to underwriters, their concern is it dropping even further.
Interesting. Okay. Maybe switching context a little bit again, Andy. Can you touch a little bit on sort of metrics, right? From as people are screening for deals and whatnot. What is important, at least these days. and maybe touch on, if it's a corporate strategic buyer versus a more of a financial PE type buyer, does that have an impact? But basically, how do you, as a buyer, how do you look at metrics per se?
Got it. I think there's the metrics. The metrics haven't changed significantly. You essentially, when I look at buyers, whether it's private equity or strategic, they're focused on, and this is in the technology space, they're focused on four things. It's revenue and revenue growth. COGS is always important because you're looking for the leverage you can get, EBITDA and cash flow. There's definitely been a much greater shift towards cash flow, and a lot of that is due to the way that a lot of transactions have been priced, and what we're seeing in the market is a lot of sell-side reports associated with the transactions, where you'll price the debt off the disclosed or the pro forma or the made-up EBITDA and the sell-side reports and cash flow. But buyers are actually looking to say, well, what do you think is the real sort of EBITDA and real cash flow that's coming off it? So they might finance it off a sell-side report, but they're looking for buy-side advisors to say what is actually what is the cash flow that's going to be able to support the debt load. Revenue is still, we're starting to see a lot more, I'd say, games being played around the revenue metrics. So everyone claims they're a SaaS business, but you quickly discover they're not quite a SaaS business. It might be an on-premise term license business. There could be a lot of services in there. So we've run into quite a bit more, quite a few more concerns, I'd say, over the last 12 to 18 months, and looking at and just passing through the revenue and transaction data that we're getting from clients. And then the other, almost coming back to the cash flow and the profitability, buyers have started to take a much more greater focus on COGS and what should be in the cost of revenue and what should really be in SG&A, so that they can start to assess what the fixed and variable components of the sort of cost of revenue are, and how much leverage they're going to get on any sort of revenue growth that's coming forward.
That's useful. That's helpful. And maybe doubling down a little bit on the PE side itself, and love to hear from the group. How has the PE activity, sort of been in the last maybe couple of quarters? How is it affecting the M&A market? Yeah, just some reflections would be helpful.
I don't know if Mark and Andy have a different. I've had a different experience, but for us, our book is split between PE and strategics, and I would say I've seen PE activity come back more strongly and earlier than I have seen strategics. I think the way they make decisions and what constitutes an opportunity is different for a strategic than it is for PE. I think the process of making a decision about acquisitions for strategic is there's a lot more stakeholders, there's a lot more people involved. You don't get in trouble for saying no to an acquisition, whereas I think that's a slightly different situation sometimes for PE. So our experience has been that PE is sort of first past the post and are getting more ramped up in this quarter.
Interesting. Mark, any other thoughts?
Yeah, I certainly agree with that. I think for folks that haven't done a lot of acquisitions, making a friend at a PE shop is a great idea. They're very disciplined about their approach. It's very process driven. It's very systematic, and I think that can be really helpful, especially if you haven't done it a lot. Because I think that discipline can be really helpful sometimes if you're on the fence about, am I going to do this deal or not? And so they're looking closely at their models, and especially I think if there's a recession, or if we just continue to have a tough venture financing market, and you've got venture-backed companies running out of cash, private equity firms will be watching closely for bargain opportunities. The one thing we've seen a little bit of is, we tend to think that technology companies can't really be sold. They can only be bought. It's very hard for them to run an auction. I think PE-backed companies tend to take a different view, that they can actually go out and find enough buyers to make that work. We've been seeing more busted auctions in the last couple of quarters where you've gotten very, low to no interest and really kind of tough scrutiny of kind of some of the fundamentals. So that's been interesting. We'll see if that continues.
Super. Just to stick with you, right? I think Emily called out the whole, and you sort of concurred about the efficiency with which the PE process runs, and less number of stakeholders and whatnot. But can you give a little bit more on, why some of these take longer, why some of these happen quicker? Just some more reflections on that itself, just the efficiency of the deal itself, and maybe if you can talk on one or two examples, actual examples that happen, that'll be super helpful.
Yeah, absolutely. I would say that the things that make deals go faster and slower tend to be kind of universal, right? But we are in an environment, I mentioned earlier, there's a whole parts of the ecosystem that are still kind of hungover. Secretary of State's offices won't pre-clear filings anymore. You can't get early termination from the antitrust agencies. So there's lots of other examples. Like it's like, there was a time where it got really tough to get any kind of rep and warranty quotes. And I know that market's kind of returned to normal, but the whole system got really stressed. And so you don't want to tempt parts of that. Particularly the regulators, who I think there was skepticism at the SEC over SPACs. I think the SEC and the antitrust agencies felt really overwhelmed. And so you really don't want to draw their scrutiny because I think they're feeling overwhelmed, worried that they might be missing something. And you don't want to be the thing they decide to sink their teeth into. The other thing that I see a lot of is the deal simple, right? Are you going to acquire the whole business? It's a straightforward purchase price. It's $100 million in cash, right? If it's a mix of stock and cash, if there's an earnout, if there's a spin out, you're acquiring part of the business, but not the whole, that's naturally going to introduce complexity, which might slow things down. The cleanliness of targets matters a lot. Did they pay attention to record and contract management? Did they think about legal compliance? This year we're at a target company that lots of startups, they don't get legal compliance right. It's hard. They don't have a big budget. I don't expect on the buy side to see people do it perfect. I expect to see a sort of baseline level of, if things are screwed up, but it's a normal level of screwed up. And at a company this year where they had found many novel ways to not comply with the law or make us worried about whether they'd complied with the law. And so until you figure out, okay, what happened, and their answers turn out to not make sense or not be correct, you dig down, you think you've got all the facts, and then you're really just trying to figure out, how do I think about this from a risk perspective? Because even as an experienced buyer, you might say, I've never thought about this before. It's not just what's the law, what's the potential fines, but what if I get a government agency mad at me? What does that mean to my overall business? Because they're not just going to be mad at the target, right? They're going to now look at my whole company and think that we're a bad actor. How do I price that? That's hard, and so that's the kind of thing where it can take a while for a buyer to, even if they stick with the deal, to wrap their head around what's going on. Had another deal where the contracts were okay with customers, but the buyer was on the conservative side, but they had real questions about who owned the intellectual property of the company, not just what was created, but the core intellectual property. And so we spent months really just trying to come to an agreement on how much risk that created. So that's the kind of stuff where that can easily tempt things. Obviously deals have died because people couldn't get financing, or financing got too expensive. So the simpler it is and the cleaner it is, and the less you're depending on regulators or third-party financing to get the deal done, the quicker it's going to happen.
Super. And just sticking with that thread, Emily, any advice around due diligence for corporate buyers? I know we heard a little bit about the PE guys, but anything to look out for if you're in the market as a corporate buyer, strategic?
Sure. So, and obviously I'm slanted towards insurance, but there has been a great deal of greater scrutiny on insurance by underwriters for a couple of reasons. All rep and warranty insurance sits excess the target's primary insurances. So it's very important to understand, if you're sitting excess something that's not very good, then the excess is not that helpful. we have found a number of companies, a sort of a problem that comes up in the mid-market, lower end of the mid-market, is companies that have not bought D&O insurance, companies that have not bought cyber insurance. D&O insurance is not that difficult to backdate, but if a company doesn't have cyber insurance in place, it's very difficult to get a firm to basically a two-road. You either get a policy and try and get it backdated, or you try and roll this new risk into the buyer's cyber policy and get it backdated. Underwriters are extremely unkeen to do that. And what it means is you have a big old gap because underwriters will put an artificial retention for any insurances that are not appropriately placed. Their attitude being, we're not here to sort of fill the gap of underinsurance. So if you don't have D&O, there's going to be a different retention for it. If you don't have cyber, there's going to be a different retention for it. And there are a lot of companies still that seem to think that cyber does not apply to them. And I don't think cyber doesn't apply to anybody anymore. So, when we have a company or there's a target and we see, one of the first questions we ask is, do they have existing cyber? Because if not, that's a problem and we need to know now, because it's going to take us a while to sort it out. So I would say, and also I think, as I said earlier, in a down economy, people start looking at insurance much, much more, because that's, a potential, from their perspective, that's a potential cash opportunity. So I would say either buyer or seller, the value of the insurance level diligence has become much more significant, and your ability to get decent quality reps insurance has become much more dependent on those targets insurances.
Super awesome. I know we are bumping up on time, but can we just step back and sort of put your thinking caps on, now that you've not been wearing them, but just some predictions on where the M&A activity will be in the next quarter or so, quarter or two. Andy, do you want to go first, please?
Yep, I can do that. I think it's probably time for us to book vacations for the next 2 months. I think it's going to be very slow in November and December. What I'm hearing from private equity clients is they're looking at a few things here and there, but they're I can get a meeting anytime I like with any sort of client pretty much just now, and they're really only talking about sort of increased activity towards the end of Q1 23. I think the mid-market sort of, let's say, sub $20 billion corporates are going to be making small opportunistic sort of tuck-in, so tech and talent buys over the next, that activity I think is going to increase slightly. And I think semis there's a shakeout in semis. There is a lot of volatility with the federal regulations around selling into China and the restrictions on selling into China. But I think that felt as if it had been a kind of more sleepy on the M&A side. So I'm optimistic that there'll be a bit more activity there. But yeah, private equity is going to be slow, as I said, for three to 6 months. It's just there's too much volatility in the market and that's impacting confidence and buyers' willingness to maybe be more aggressive and optimistic.
Super. Mark, any thoughts? And maybe are there certain KPIs or certain parameters to look out for that might be leading indicators, if you will? But same question.
Oh, that's a good question. I don't know, maybe like looking at like late night food orders to the various service providers on this call to their offices, and to the extent they're back in the office. I do see some deal work picking up. I don't know though if that's the end of the year is here, and if we want to have any chance of having a sign or close before the end of the year, we got to get going. I think it'll be more of a test to see if that activity continues in Q1. I tend to, I've only been doing this for about 15 years, and it feels like in up or down markets, we can be really busy. The times when we're the slowest, it's when we make the transition between the two. And so Q3 was pretty slow. Q4 feels a little busier. Does that mean we've kind of flipped and now we're going to be doing, deals in a down market? Maybe. That's sort of what I know so far. Ask me again in 6 months.
Thanks. Emily, thoughts?
I think I'm slightly more optimistic than Andy, but I think until there's, until the interest rate has settled, I think it's very difficult for people to know what something's going to cost. So it's very difficult to evaluate whether it's a good deal or not. I have seen more activity. I do think there may well be the usual sort of fourth quarter push, just to avoid going into next year. But I think once I expect to see things become more stable, and as Mark says, we're in that transition period, which is the sort of dead zone where we don't know whether we're in an up market or a down market. Well, we know which way we're going, but we haven't got there yet, right? We haven't worked out where the bottom is. So I think I'm more optimistic for next year, probably second quarter of next year, but I'm hoping there'll be a little flurry of activity before the end of the year.
Super. One quick question snuck in on the Q&A thing on the chat. What about the global M&A? So basically, this from a seller point of view, any insights on positioning there? Maybe Emily, any thoughts?
We're seeing, I would say, we're seeing less European activity than we were. I think that is a very nerve-wracking, and as a British person, I can say it would appear that England is in some kind of problem. So I think until things are a lot more settled, certainly on the European side, which is where we see the most of our international activities on the European side, that seems to be a nerve-wracking proposition, but maybe Mark or Andy has a broader global perspective.
Go for it, Andy. I can follow you.
Yeah. So what's interesting is I'm seeing a lot more interest from US buyers into Europe than I have than I did last year, and I think it's a reflection of just the decline in the value of the euro and sterling. So it's become a cheaper market. You might not have been able to make it on metrics, but I think some bidders are looking and saying maybe we've got a currency arbitrage here as well at some point when the dollar flips back. I've seen a little bit more activity in Japan than I personally. I did very little in Japan for many years, but in the last year I've seen a handful of transactions there, which is interesting. And I think Japan's getting to a stage where, with the decline in population and the aging of the population, they need to find a way to exit some of these, or shareholders need to find a way to exit some of those businesses. I'm seeing very little on the inbound international deals into the US. There's been a handful this year, but not as serious and not as just not as serious as they were a few years ago, or not a few years ago, but the previous year.
Mark?
Yeah, I'm surprised I haven't seen more activity looking to buy, companies in the UK and Europe because of the currency shift in favor of the dollar. So, we'll see how that bears out. I'm still kind of waiting to see a lot more buy side activity going into the UK.
Super. Let's maybe move to a lightning round. Just if you were to give like one piece of advice for the attendees to sort of walk away with, I think this shared a lot of perspective, but anything that you want to put a pin on and sort of sum it up? We'll start with Mark and then maybe go around Andy and Emily.
Yeah, sure. I think, if you haven't done a lot of M&A, right, thinking a little bit about kind of what you're trying to do and understanding who the other decision makers are internally, I think it's really important, right? So what's the thesis? How are we going to grow? What's going to be the organic piece? What can we build on our own? So we're going to go buy it. So that's the inorganic piece. How are we going to allocate resource to that versus, other things internally? And then really having a process, because I think it's hard when you're being buffeted by market forces to know, is this a good deal? Is this a bad deal? There's a trend. What am I supposed to do with this? having thought through some of that makes it easier to know, oh my gosh, there's this company, but it seems like it's too much money. And if you scoured the market and you know whether or not there's 10 other people you could buy that would do roughly the same thing, that makes your life a lot easier than if you're acting without that information. So I think kind of laying some of the groundwork can be really helpful in evaluating opportunities.
Super. Andy?
Yeah, a couple of things that, and not explicitly M&A related, but if you've got a company, get as much cash as you can. I think debt is going to be much more expensive in the next 6 months. So you should be trying to get sufficient resources for 12 to 24 months, and that's also a reflection. Even if you think you're going to sell yourself, it's taking much longer for transactions to close. And if you're up against a wall or a funding crisis, you're going to get a much lower price. So if you've got 24 months of cash on hand, then you're in a great position just now. If you've got less than 12, then you're essentially going to loan sharks just now and paying 15% plus interest if you're a small startup company is what I'm seeing in the market. I think the other thing, and this is really to Mark's point about just getting your house in order. A year ago, it was pie in the sky, optimistic projections. I think you have to be much more realistic. And when you're sort of maintaining your operating model or your valuation model that you may share if you're going to sell yourself, or at least going to be sharing with your bankers if you need additional equity or debt as part of an acquisition, is being thoughtful, making sure it's consistent, and being realistic, and so it's grounded in what's happened over the last 9 months. Even if there's a sort of growth factor built in, and you have to have a growth factor. It's not a 50% a year revenue growth. It's maybe 20% revenue growth for a SaaS company, for example, or whatever the appropriate metric is for your specific part of the market. I think there's been too many bidders have lost credit, or too many companies have lost credibility by making up numbers that with any sort of scrutiny quickly fall apart.
Super. Emily, you want
to? I second what everybody said. Definitely having enough cash to survive for at least sort of 18 to 24 months makes you a far more attractive proposition. I do think that, obviously the focus has shifted from growth, as Andy's saying, to profitability and stability. In those industries that are recession-proof, if such a thing exists, are going to be far more attractive. I think it is a process. Expect it to take longer than you want it to. And yes, we do have to let go of last year when we're thinking about valuations, right? That was an anomaly, and have to have a realistic attitude to what's happening right now.
Super. This has been phenomenally helpful. Colin, do you want to open up any other questions live? Yeah.
Of course, yes. Well, first of all, Raghu, thanks for leading such an amazing discussion. Emily, Andy, Mark, thanks for sharing all those buy-side insights and some of the sell-side insights and those last takeaways there. We're going to double whammy here. If you haven't submitted your questions for our panel in the Q&A box, do so now. We'll try to get to them all. We also have some pre-submitted questions we'll try to get to. But let's just roll right along. So you talked a little bit about, and I'll offer this one up to David and Mark and Emily, of course, if you want to jump in. But we were talking a little bit about international M&A transactions. And so somebody's asking a little bit about what the deals like for a U.S. company attempting to purchase a foreign one look like. Are they more complicated? Is it more difficult? Can you talk a little bit about that?
Sure, happy to jump in there. I would say that it's going to be a little bit more difficult as a baseline, assuming an otherwise simple deal. And part of that's just the sort of translation issue. And I don't mean from a, English to a different language issue, but just deal assumptions, right? If you've done deals in the US, there's a typical way of thinking about valuation issues, about thinking about risk sharing and how the parties tend to balance that and what the norms are. And those norms can be really different in other countries, right? You may also run into different kind of legal hurdles to get the deal done. And so understanding understanding that up front can be really helpful. You know, in the cross-border stuff I do in the UK, very big differences about how much risk sellers ever are going to take on, and sort of at what point in the transaction that those risks can shift. And so you don't have those conversations up front. You can often have a 2 to 3 week period where you're sort of staring down at each other, stuck, because your expectations are very far apart.
Super helpful. Andy, any comment there?
No, I think clearly if you're in maybe semiconductors or a sensitive area, then it's a completely different ball game. But if it's a regular, enterprise SaaS business, then I think to Mark's point, is really just the cultural aspects, and there's a level of optimism you get in America that you don't get, or in the US that you don't get in Europe. So just sort of becoming more culturally aware sometimes can play a big part in getting a transaction done.
Emily, any perspective from insurance reps and warranties risk perspective?
Yeah, I think Mark hit it on the head, especially UK transactions. What is normal? What is market in a UK transaction versus what's normal in market in a US transaction is very, very far apart. And the legal system and the ability to reclaim money after the event is also very different. A lot of our clients use rep and warranty because they want American style terms on their deal, but they're only getting British styles being offered by the seller, and using the insurance to sort of bridge that gap has become very common practice in sort of US to UK and increasingly European deals.
Amazing. Well, I'd be remiss if I didn't tap our amazing moderator, Raghu, for this. One of these questions that came across. So how would one approach managing your VCs on board when discussing an acquisition? This entrepreneur is worried that they're thinking we're giving up on the business. Any insights there?
I think the environment we are in, right, and the stage of the company, it's going to be very subjective, but I think taking at least the board members along for the ride, I think will be important, meaning have them be part of the strategic discussion, right? Typically, and at least we have like at least a few portfolio companies that are going through that process with other investors as well, which is, here are our strategic options, and definitely the M&A thing is on the table, right? You don't want to rule anything out given the environment we are in, subject to what your runway is and subject to what kind of customer traction you're having and what your net burn is. So I think it's not it's not a compartmentalized I'm just going to have an M&A or like try to figure out a sale conversation with the board and the investors. It's more look, these are the options, and we have to, what may not have been on the table, which is the M&A thing or the finding a buyer piece, maybe 12 months back, maybe now it is, and having that open conversation will be constructive more than destructive. So I would, that's how I think at least our portfolio founders have been very open about exploring all these options. So
that's super helpful. There's an ops question, but I'm curious if, Mark, you have any insights just based on the deal terms. So somebody asked a question on how much planning and process is given to integration. So with respect to culture, business planning, and IT, do you have anything that you see across the table? Of course,
it's not something that we get to be really involved in. And so I like to try to check in with folks afterwards to kind of see how it went. And I think it's really, if you've ever taken sort of classes on M&A and say like, law school or business school or some other context, there's a lot of studies out there that suggest that, M&A can often not be value creating, which is a humbling thing to realize when that's kind of your day-to-day job. And I think integration is a big part of it, right? Do you understand what you want to do at the outset? Like, what's the thesis? Is this, we're going to leave it alone because it works really great? Does it only make sense if we integrate it? And make sure that integration process is sort of clear at the outset so that the team that's going to integrate if it's different from the deal team, that they're involved. So it's not like, hey, deal's done, deal team goes away, integration team has to pick it up, and they have to relearn everything that the deal team already knows. Or they feeding into the process and saying, well, the diligence isn't just about what are the issues that might affect price, or do we want to do the deal? It's what's all the stuff that we want to make sure the team that's going to integrate knows they've got to fix in the next 6 months because there's problems with the code or the contracts or what have you.
It's helpful. Andy, Emily, anything to add to that?
Yeah, I'm seeing more integration in or a greater focus on integration in the last couple of years. And I think that might just be a function. There's more integration consultants on the market, so they need something to do. So they're out selling to clients. I'm seeing a lot more private equity are doing a lot more roll up, sort of platform transactions. So there's an integration element there. But the interesting aspect to it is they'll talk about integration, but integration these days is fundamentally based around what happens to your IT system. And a lot of these entities that you might do a roll up of 10, 20 different companies with different systems to really integrate it. You've got to almost do a full scale IT transformation, and they're expensive and disruptive. So I'm seeing maybe more lip service and more band-aids around kind of how IT is combined rather than a full scale. Let's switch from a NetSuite to an Oracle or whatever, an Intact to like a NetSuite or whatever the system conversion is that's taking place. But there's definitely been a greater emphasis on it than in the past.
Brilliant. Emily, anything to add?
No, I mean, I've seen the same thing that, the deal team is not necessarily the integration team, and that can lead to a disconnect. And I'm seeing more integration team being part of the discussion on a go forward basis. But I still would say that they are pretty separate functions very often.
Yeah. Well, it's helpful to know those perspectives at least. Another question here that came in is around what does rising interest rates or inflation have an effect on M&A? Andy, maybe I'll start with you.
Yeah, it's not helping it, I think, is probably the best opening line. It's two reasons. It's just increasing volatility in the market, which makes people pause around, or it reduces confidence that growth is going to occur over the next sort of year or two, and it's just making debt more expensive. So until you get alignment on sellers' expectations and buyers' expectations, there's going to be the market's going to be slower. There's just going to be less volume. I think we may be entering a period where interest rates are at a permanently higher level, and that may be reasonable, but you can't have sort of consistent increases or that volatility in interest rates going up every month. The market has to get comfortable that the interest rate or the rise in interest rate is stopped, and I'm not sure it has. I think the central banks in the developed countries are maybe still a bit too slow at increasing interest rates. And there's an interesting article, I think, yesterday in the Financial Times where they talked about the developing countries, particularly in South America, are much more aggressive at raising interest rates because they've got much more experience in dealing with inflation. And I wonder if people are talking about another 2% interest rates, but if indeed it's actually slightly more than a 2% increase in interest rates.
Mm. And Emily, on just reps, how has it affected reps and warranties insurance pricing? I mean, last year and the following year, there was some pretty sky high prices, understandably so. But do you think that's going to affect insurance?
It affects insurance in the sense that it affects deal flow. So, as Andy says, I think the bottom line is it's not making it any easier. However, when there is not a lot of deal flow, rep and warranty insurance pricing goes down. So you could argue that inflation is helpful in that respect.
Awesome. Mark, any additions?
Yeah, I think the corollary to the idea that debt's expensive, therefore cash is more valuable. We saw an uptick in stock based compensation in last year, and I think that's only going to continue.
Raghu, to include you on this one, how's interest rates affecting your desk on the VC, the other side of the table?
I don't know. I mean, I don't think interest rates are, at least I don't think we are seeing that much. I think the deal flow has definitely gone down in many senses. But there's only so much, so long that we can, not deploy capital and just sit on the side. So one thing I'm seeing is some of the notes that we invested on, and for the companies that haven't raised for a long time, the accumulated interest on the note has been an issue for newer investors coming in, and I don't know if that's only going to get worse going forward. But yeah.
Super helpful. Well, we're almost at time, but there is an interesting question that I wanted to invite to our esteemed panel before we close out. So what's your outlook for take privates and PE buyouts of a public company? Andy, maybe I'll start with you.
I think there's going to be I think the market's going to be slow for 6 months. I just don't see as many arising because the PE buyers are waiting to see what happens in interest rates and are waiting, particularly this quarter, to see how results are coming through and what the overall demand is in the market. But there's a lot of smaller tech companies out there that may be less efficient than they might be under PE ownership. And so in Q1, Q2, I wouldn't be surprised if you'll start to see more take privates at the smaller end, and then maybe more combinations of so companies in adjacent or competing industries to build up a platform that can then either IPO or be sold on to another private equity or a club deal.
Awesome. Lightning round, Mark.
Yeah, I think it depends on what that looks like. If the private equity deal means that they're going to finance a big chunk of it with cash, with debt, that the company they acquire has got to be able to service that debt. And so if we think about, who does, so if it's for cash flow positive companies, that could work, right? We know debt's getting more expensive. Where it may not work is, for example, like recently de-SPACed companies, many of which were cash flow negative. Right, so they're not going to be able to support. You can't use debt. It'd be hard to use debt for that, right? Because they can't service it. So it'll be interesting. I might be a little more optimistic than Andy, but in a rising interest rate environment doesn't make me terribly optimistic about that particular deal structure.
Awesome, Emily, round us out.
Yeah, I'm not sure that structure is immune to the things that are happening in the market and the general sense of unease any more than any other structure.
Amazing. Well, Mark, Emily, Andy, and Raghu, thank you so much for joining us today to share more about your perspective and your desk on the Buy Side Insights. We really appreciate your time, expertise, and I'm sure our attendees do. For those of you still on the call, if you'd like to book a meeting with any of our esteemed panelists, we're going to launch a quick poll. Also, we've got a link in the chat for a survey. But Mark, Andy, Emily, Raghu, thank you so much.
Thank you.
Great to have you back on the platform.
Thanks,
For those of you still on, we'd appreciate your feedback, so fill out that survey. Also, we've got a ton of programs coming up at the center in the next couple of months, so check those out in the link in the chat and in the follow-up. But from all of us here at the Nasdaq Center and from all of the team here, we thank you for joining us today, and we look forward to welcoming you back online soon. Have a good one, everyone.